Today's episode of the Nutgraf, published on 14th of June 2025, is titled Kunal Shah and Founders Who Fund Their Faith. Everyone else sees a dip, some founders see a discount on their own conviction. You may have your opinion about Cred as a product, but you can hardly accuse it of being a boring company. Anyway, here's the latest, and I'm quoting the ArcWeb story titled Kunal Shah invests $19 million in Cred's down round at $3.5 billion valuation. Quote, Fintech unicorn Cred is raising $72 million, that's rupees 617 crores, from its existing investors after a nearly 3-year hiatus, according to filings with the MCA. The funding round will lower Cred's valuation to $3.5 billion, a 45% drop from its previous $6.4 billion valuation in 2022. Singapore's GIC, which 3 years ago led a 1,170 crore or 140 million investment in Cred, is also leading the current round with rupees 354 crore or around $41 million. RTP Global and Sofin are also participating. Cred founder Kunal Shah is expected to contribute around 162 crores or $19 million in this internal round, which has reportedly been finalized and is likely to be announced soon, according to the same sources. This will make it one of the founders' most significant personal investments in their startup in the ecosystem. End quote. There are two parts here. First, Cred has gone through a down round, and second, Kunal Shah, its founder, has invested more capital in it. More often than not, a lot of attention is paid to the first part, and the second is either overlooked or mentioned in passing. I think the latter is far more interesting than the former. Down rounds are somewhat of a taboo in the startup universe for reasons I've never fully understood. While share prices of listed companies can freely move up or down, privately funded startups are expected to go only in one direction, up. I've previously argued about the downstream and second order effects of this inequitable expectation, and usually the price is paid by the retail investor when the company goes public. I've described this in somewhat morbid terms as, quote, the great fattening followed by the great slaughter, end quote, or the foie grassification of Indian startups. Consequently, we end up with curves that look like early funding, growth funding, and IPO listing going all the way up, and a post IPO sell off where the share price of the company and the valuation collapses, followed by a long, steady plateau when the company is in a public market. So, anyway, I'm all for down rounds. It's fine. It's also bland and frankly boring. The far more interesting part in all this is that over 25% of Cred's new funding has come from its founder, Kunal Shah. This isn't how things usually go. Founders typically start by building something, selling a vision, hiring a team, and getting things moving. Then at some point, they head to people with money, usually VCs, and try to convince them to bet on the dream. The VCs look at the pitch, the people, the product, and if it all works out, they shrug, nod, and write a check in exchange for a slice of the upside. But sometimes this is not what happens. Instead, the founders decide to do it all by themselves. And these are the founders who have the capital and the will to do what I'm calling faith funding. Faith funding is when founders switch roles and become VCs and invest into their own companies, like fantasy monarchs who ride back into the battlefield with their hidden vault of gold to defend the castle when the walls are crumbling. These founders protect their stakes and even double down when others retreat. They don't go out and sell their vision to others. They don't ask others to trust them. They fund their own faiths themselves. In other words, they don't just lead in the battlefield, they bankroll the war. It's not like founders did not do this in the past, but their circumstances have been widely different and, dare I say, not ideal. There are several examples of founders who have done this in India for different reasons under strange circumstances, and once you read them in tandem, you'll see what I mean. The first kind is when the founder more or less funds and controls their company right from the beginning. If you like, you can exclude companies where founders have actively avoided VC money because they want to stay in control. As an example, Sachin Bansal and Navi. But then you get startups that, well, nobody really understands. Perhaps it's because it's way too risky, even for VC investors. And, well, the founder has access to enormous amounts of capital. There are no clear revenue streams. Think of it as a massive hobby project. Just last week, I wrote about one of these. That's Krutrim and Bhavesh Agarwal. The other kind of faith funding happens when the company is distressed and the founder sees an opportunity to assume greater ownership, and there are no easy ways for other investors to object to this seizure. Famously, this happened with Byju's almost exactly a year ago on this day, when its founder Baiju Ravindran wanted to raise money at a 99% cut in valuation, essentially putting a gun to the heads of all existing investors of the company to either participate or face a dramatic dilution of their equity. At that time, I was even somewhat sympathetic toward Byju's, even though I was quite amused by how bizarre the whole thing was. Yet another kind of faith funding is the one where the founder does something so bizarre and unprecedented that people just roll with it. Hello, Oyo and Ritesh Agarwal. I could spend an entire edition trying to explain all the strange things that Ritesh Agarwal has done to inject funds into Oyo, and I doubt we'll still understand the whole picture. Suffice to say, the bottom line is that through a series of complicated loans, share pledges, and other things that I've already written about earlier, Ritesh Agarwal owns nearly 33% of Oyo, and SoftBank has another 46% of it. I guess you can see why founders doing faith funding was generally seen as an undesirable thing. Faith funding was viewed with suspicion, and for good reason. A founder putting money into their company is a sign that they could not convince someone else to do the same. It's fair to say that faith funding was a taboo of sorts. However, strange things happen during a downturn. VCs get more skittish, and some founders are seeing this not as a crisis, but as an opportunity. Kunal Shah isn't even the first startup founder to do this. A few months back, Gaurav Kumar, founder and CEO of the fintech company UB, also invested 250 crores into the company. And sometimes founders don't even have to pay the entire money upfront. In October, consumer lending and payment startup Slice raised 72 crores, that's around $8.6 million, from its founder and CEO Rajan Bajaj through partly paid up shares. Over the last few months, faith funding hasn't just become palatable, it's become more powerful. The taboo is wiped away, and the founders and companies become much more attractive. Like with most things in life, this is all a form of game theory. When everyone has capital, founders doubling down on their own companies is seen with suspicion. On the other hand, when capital is scarce and when founders are actively trying to exit the companies they founded, the founder who's doing faith funding looks much more attractive. It's a sign that this founder isn't going anywhere and that they believe in the startup so much that they're willing to buy shares at it at this price, confident of an upside later. And VCs, who are mostly creatures of FOMO, usually ask themselves, what does this founder know about their business that we don't? And usually, that's enough to get past the line. Today's edition of the Nutgraf is read by me, Praveen Gopal Krishnan. You can find the entire edition on our website. That's theken.com/thenutgraf. Sound and production for today's episode is done by Rajiv CN. And I'll see you again with another edition next week.